Hey there, it's Trisha, and I want to go over something that you might find helpful in the volatile environment that we've been having the past week or so. And I'll show you something that might help. This is from Friday, but you can use it on anything that you're trading. And if you want more information on the setups that we're using, you can go to www.easyeminitrade.com. So this is the NQ that I'm going to show you, but like I said, you can look at it on anything, the ES or the 6E, whatever you're trading. And so the issue is that when we do have a lot of volatility, here's the tick, and very simple explanation for that is when we're trading, when this is plotting above zero, you have more New York stocks trading on an uptick. When it's trading below zero, you have more trading on a downtick. And we do have extremes on those. And the lines that I have here are 0, plus and minus 600, 800, and 1,000. Here's minus 600, 800, and 1,000. And consider really plus and minus 600 neutral. But when we have a volatile day, you'll find that we're going to have many tick extremes. And many tick extremes would be in the 700s on up, plus 1,000, plus or minus. And when we do have many of those, it just tells us that we have a very strong market or a weak market, which is great because then it's going to continue typically moving in that direction. The issue is that you want to be able to hop on board somewhere on into the trade. And the thing about when we get a tick extreme is that usually what happens is we wind up with a large bar, and then the tick will pull back a little bit and price will pull back a little bit, and the issue is always, are you going to be stopped out when it pulls back? So you have a couple options when you're getting many tick extremes, because obviously when you have many, you don't want to have to sit back and sit out of the market. You want to be able to get in somewhere. So here's the issue. On a 1-minute chart, we have a setup, and this is in the morning on Friday, and we close outside the channel. We've got room above us, and so we take it, and it works out fine. But the issue that we've been running into last week, and I say last week because I'm making this on Sunday, but what happens is you get in, and then a tick extreme, then the price pulls back, and then it stops you out. Typically we like to use a 2.5 point stop, but here are the options that you can use. One option is that for your setup bar, you can actually use, what we do is we get in above the setup bar and a 2.5 point stop. You can always use a quarter under your setup bar as your stop. Now, when we do have many tick extremes, that bar could wind up being 4 or 5 points. So I'm not sure that that's something that you want to do. If it's not, the other option is that you can trade off of a 1-point range bar chart, or you can trade off of a 1.5 range chart. And what that simply is each bar using a 1-point range represents 1 point. So for example, if you have a bar here that's, let's say, 4 points in size, instead of being one large bar, you're going to have 4 bars. And so the only thing that I would suggest is that when you're taking the setup on this, when you're getting closed outside the channel, I would use the ADX on a 1-minute chart, because it's going to not really work out very well using the ADX on a range chart. So again, you can use a 1.5 point range or a 1 point range. You can also use a tick chart if you like a 377 or a 512. But the issue with that is that you're still going to wind up with some large bars on those. So realistically, you're going to want to increase your stop size to just under or below the setup bar. And it won't be like this forever, but for now you just have to kind of make changes so you're not continually being stopped out, and then just to watch price go in the direction that you anticipated. The other option is that on the NQ, here's a 3,000 tick chart, and you know that I like to look at the broader view of the market on a tick chart. On the NQ, I like a 3,000. On the ES, I like a 5,100. Something that we've been paying attention to in the room is that when our 9-period moving average, I kind of colored it here so you can just see, I have it colored with the slope. When we get closed, let's say for example, above that 9-period weighted moving average, and our MACD is in line here, meaning our MACD line is above our MACD moving average. and the slope of our moving average is going higher, you could enter in just above this bar here, and of course you'll be in for a longer period of time, and you're going to have a larger stop initially, but the thing to remember is that you're going to catch large moves, which is really nice. So you can make your targets +3, +5, and then just trail stop using a quarter under each bar as it progresses. Initially, if you're using the bar that sets up, like for example here, the stop is going to be pretty large. You could always opt for making your initial stop just under that moving average, and then once you get your targets, like I said, you can trail as price progresses. So you would have easily, been in this for a while. You would have never been stopped out until here, actually, under this bar here. If you move your stop under this bar here, that's the bar that would have stopped you out. And you would not be looking for a short here. You can see you get closed under that 9-period weighted moving average, but the slope still on it is moving higher. Also, the MACD is still in line for a long, so you're not going to be interested in that. Here, when you get closed back above that 9-period moving average, you could opt to re-enter. It closes above it. This is still in line for a long. This is still sloping higher, so you could take it. You would not be interested in looking for a short until your MACD crosses below your MACD moving average, which would be here, and you want to get a close below that 9 with your with the slope. And you can see right here that the slope, even though it's colored on the pinkish side, it's going sideways. So when you see it going sideways, just stand aside, because often what you're going to find is that you're going to close above it, close below it, close above it, close below it. So just let it pick, get an angle going, and then realistically you can enter in under this bar here, knowing that this 55 moving average below us is likely going to act as an area of support. This is our Fibonacci 50% retracement, so you know that that's likely going to be an area that you're going to stall. So that's going to be your target area. So I hope that helps. If you have any questions, you can always shoot me an email. And we are actually working on refining our alternate entries, and I should have that ready in the next week or so. We've been testing it in the room and taking them off of a 1 point or a 1.5 point range. So it's working out really well, and I'll share that with everybody once I do get the details ironed out. So I hope that helps, and happy trading tomorrow.